So for a lot of people, stocks feel like this abstract thing. Just numbers on a screen, charts going up and down, headlines about the market being up or down, and of course, the newest Instagram influencer with a bunch of cars and mansions that's apparently better than Warren Buffett at trading stocks. And that confusion usually leads one of two ways. People either ignore stocks entirely and just avoid them, thinking the entire thing is a scam, or they gamble and treat it like a casino and a get rich quick scheme. But really, simply put, a stock is not a bet, it is simply just ownership. When you buy a stock, you're simply buying a small piece of a real business. This business sells products or services, it earns money, it pays expenses, and it makes profit with what's left over, and it tries to grow over time. So you're not just buying a ticker symbol, you're buying a claim on future profits and growth, as well as, if things don't go so well, you're buying a claim on future losses and devaluation. So let's say you buy into a company called Straight Up Wealth. The company has 1 million shares in total, and you buy 1,000 of them. You now own 1% of that entire company. You are a partial owner. And public stocks work the exact same way. The difference is just a matter of scale. Usually, the ownership of companies that you're used to hearing about, things like Apple and Microsoft and Nvidia, it's the same concept, but there's millions of shares available and they're traded openly to the public market. So remember, when you're buying a stock, you're buying one of those pieces or X number of those pieces, and the stock market is just the location where this buying and selling happens. Now, when you look at it from the company's perspective, why do companies sell stock? Well, they do it to raise money. Instead of taking out massive loans from banks or just using the profits that they're making, businesses can sell ownership stakes to investors through the stock market and raise capital to expand their operations, develop new products, hire talent, or invest in research. So when it works out well, it's a win-win scenario. Companies get the funds they need to grow, and investors get the opportunity to profit from that growth. That's why you see stuff like Shark Tank, where these entrepreneurs come on and they need what the sharks have, their money, their network. And for the sharks, it's a great opportunity because they don't have the time necessarily to build their own company from scratch. So they invest in these entrepreneurs and hope to benefit from that profit down the line. So, why is this important? It's because stocks are at the center of long term wealth building, whether people realize it or not. Pensions rely on them, retirement accounts rely on them. Most long term financial growth depends on them in some form. Unfortunately, a lot of people invest into stocks not knowing what they're doing, or they stay in cash because they feel stocks are too risky, complex, or intimidating. So, how do you actually make money from stocks, or how do you even buy and sell them? So stocks are listed on exchanges, and you've probably heard of them in the news even though you didn't know what you were hearing. Things like the Dow or the New York Stock Exchange or the NASDAQ. And it's not like the old days where you have to physically be present or you need paperwork. You can access these stocks simply through any platform of your choosing. And you've probably heard of lots of them: Wealthsimple, Questrade, Robinhood, whatever you want. And the first way you're actually going to make money, capital appreciation. So this is when the stock price increases from where you bought it. So let's say you bought a stock for $50 and you bought one stock. And then that company grows over time, or they're more profitable, or they're more popular, and now that stock is worth $75. If you choose to sell it, then that $25 that you just made is the capital appreciation. And then the second way is through dividends. Dividends are basically a small portion of the profits that companies will share with their shareholders, usually quarterly or at some time interval. You can think of dividends as being your reward for being an owner in the company and earning a slice of that company's earnings directly to your account. Now, obviously, it might not seem like much when you're not that invested and you're only making, 20 bucks every quarter. But if you think of Warren Buffett, the amount of dividends he gets from a company like Coca-Cola, it's in the order of hundreds of millions of dollars without ever lifting a finger, without ever being in a Coca-Cola factory or in their board meetings, just by being invested in the stock. Now, what actually causes stock prices to move up and down? It's essentially based on supply and demand. How many people in the market are trying to sell that stock? How many people are trying to buy it? And that alone is affected by tons of other factors. It can have something to do with the underlying company performance. Are they more or less profitable in this quarter than they were expected to be? It can have to do with economic conditions unrelated to the company. Are we going through a recession? It can have to do with industry trends. So you see AI stocks are through the roof just because that's the time of life that we're living in right now. Another important one is investor sentiment. This is basically, how do investors feel about the market? Do they feel like the market as a whole is overpriced, it's due for a correction, or is this company overpriced and it's due to be sold, or vice versa? Sometimes it can have to do with news events. So when major tragedies occur in the world, you'll almost always notice stock prices going down. It can have to do with random tweets or news events that provide speculation about the future. This is why you saw in 2020 when there was a lot of panic, markets suddenly crashed down a ton. Now, there's also public versus private stocks. Not all companies have stocks that you can just buy on the public markets. Some companies are owned by small groups of people, often the founders and the early investors that they know personally. Whereas public companies you see on those exchanges we talked about where they're available to anybody to buy. And when a private company decides to go public, it's often through an IPO or an initial public offering. That's when private companies begin to offer stock ownership to the public. So, like I mentioned earlier, for most people, the day to day prices of stocks and their changes really isn't going to matter much, and it shouldn't. The vast majority of you, including myself, are not going to be day traders or hedge fund traders. And if you are, I'm not sure why you're watching this video. But for most of us, stocks are just going to be a piece of the puzzle that contribute to long term wealth. So do your own research, see what you believe in. This is not financial advice, but a good concept is to keep it simple and keep it long term. Instead of getting caught up in tweets and news and what other people are saying, just think with your logical mind using common sense. What are the underlying numbers of this company if that's the kind of thing you're interested in? Or if you're interested in ETFs, which we'll talk about, which is just a grouping of stocks, then even though the prices might change day to day, has the overall big picture changed? Even though the price is down today, do you still believe in this company or this ETF in the next 20 years that it's going to be able to fund your retirement? If so, you have nothing to worry about other than maybe even buying more when the price is down. And similarly, when the price is up, if you're in this for the long run and you're not looking to sell, then don't worry about how high it is. It gets easier when you just remember the basics that stock ownership is ownership in a company. So, do you or do you not believe in that company based on their numbers, based on what you know, and accept that short term volatility is expected and it's normal and it's out of your control and it's nothing to worry about. So, remember, don't treat it like gambling. Remember that it's ownership and remember to play for the long run. And that's really the bottom line of what stocks are and how to benefit from them. There's tons more lessons and videos we're going to make that go in depth on what ETFs are, index funds, passive investing, active investing, stock analysis. And that's all coming down the line. But this was just a good overview and a very basic overview of what stocks are. And it's very important for you to understand.